Happy New Year, everyone. Thank you for joining us. As always, you are welcome to raise your hand during the call and ask a question to the group. Otherwise, chat, please. And at the end, we will go through all the questions and answer everything that comes into us. Again, we're very happy and excited for another new year here at Petso Financial. So I'm going to go ahead, turn it over to Dave, and we'll get going.
All right. Well, welcome everybody, and Happy New Year. I hope you had a great holiday. It's interesting this time of year how many predictions come out, and predictions of the future are, as Mark Twain said more eloquently than I'm about to, really rather difficult to do. It is not possible, but it's what we do, and it's just this natural reaction that people have. I want to know what the future is. How do we, what's going to happen in the markets? And so I thought the best part of this today would be kind of a quick look back. And yes, some things are changing, and that's not a predictive statement. It's just we want to be, if you will, communicating what some of those changes are. Okay, we're not running for the hills. We're not overly worried. I know that the world-ending doomsdayers come out in mass force in every December, and it's always different this time. The deficit is higher. There's more kooky political people. The president can't even figure out what door he's supposed to leave. I get it. There's a lot of stuff going on, and there is every year. This is not different. So as we turn the page back and look back at 2022 and 2022 ended a tough year. Stocks were down. Bonds had their worst every year. Bonds were only up 2% this year. As a matter of fact, let's go ahead and pull up that comparison, 22 and 23. And what's so fascinating about this, and I think just chock full of lessons, as we focus first on the gray bars. Okay, that's 2022. Okay, so the only thing that worked at all was energy in 22, which didn't work in 23. A pretty big lesson there. But as you look at all of these bars, they really are mirror opposites, aren't they, by and large, right? It's not like for 2 years in a row, we've seen tech stocks really ramp up. We did not. We haven't. We've seen negative markets from Japan, and whether it's global developed equity, it's emerging markets, it's all across the board was a negative year in 22. So as we think about this, we're basically back to where we were. But you wouldn't think that Wall Street reacted that way. It's like, well, here we are. Things weren't so good in 22. Here we are in 23. It's all about the same, and everybody kind of held their positions. That is not what happened. And that's why it's important to review and think about as we hear the predictions. Everything from doom and gloom, which sells. It's not okay to say, what you probably ought to do is own things and then just own the great corporations through good times, through bad. That's just not going to sell gold bars. It's not going to sell clickbait views. It's not going to sell any newsletters at all. It's going to simply say, oh, well, that happens to be what the truth is for the last zillion years. But it's that time of year where predictions come through. So let's quickly review. In 22, you were supposed to be owning only value stocks. Or I'm sorry, yes, only value stocks. And of course, growth stocks. I said it totally backwards. In 22. By the end of 22, after the growth stocks got absolutely decimated, some of them like Meta, used to be called Facebook, was down 70% that year. 70. Then we have changed our mind by the end of that year, and you can't own tech stocks, even though by and large, Amazon, Google, Apple, all the others, right? Lumping it in and saying all these corporations, whether you like what they do or not, dominate the world. You don't want to own any of those down 40, 50%. You need to wait because interest rates are rising and we know better than you. You should not be doing that. Stick with the value stocks that are holding up better. because now is the big turn, right? For the first time in 15 years, value is going to outperform growth. It did in 22, and it's going to keep going. We're going to play catch up now. And then Wall Street told you the PE ratios would be such and such, and the earnings would be such and such. This is why we steer away from predictions. Because how valuable was it, for example, for JP Morgan to tell us, just picking on one company, Goldman Sachs, all the others, same thing, was going to be at 3,200, when in fact it's 4,700. How valuable is that? And also actually having us buy the wrong stocks on top of that, right? You shouldn't own any of the tech stocks, which is why growth portfolios are up like the market, 24%-ish. Some are up more. It depends how much of a weighting you have in tech. So 23 is a mirror opposite. We see value stocks going down. Now we get to the end of the year and we hear the market predictions. And I hear, Dave, there's more talk this year than I can remember about how the end of the world is here. And it's like, no, it's not more talk. It's the same. It's just louder. Why is it louder? It's louder because it's so easy to have a platform on a TikTok, Facebook, YouTube, or the internet. And so we have this loud noise. But I got to tell you, this harkens back to me to the 1980s when I first started in the industry. People like Howard Ruff, he did a TV show called Rough House, where basically forever, he just said the world was coming to an end, and he wrote books about the world coming to an end. He died rich, I'm sure, but if you followed his advice to the decades of the 1980s, you would have lost 91% of your money. 91. But it didn't stop people from buying his newsletters all the way through the decade, because bad news sells. All it's changed now is that same type of person in the form of now, who was the last one I had people send me some video clip or news clip of Dent, Harry Dent, who famously wrote Dow 40,000 right before the market crashed in 2000. So they had an updated one, and anyway, it just goes on. He's never right. And even if you say, well, stopwatch is right once in a while. Remember, the market went down a lot in 2008 and 9. You're right. But he didn't get you back in. So what does it matter? That he was right for 1 year, for one brief period of time, that the market did go down a lot. If you don't get back in, it doesn't do any good. In other words, he's never right. Why would I care about people's opinions that are literally never right? That all they ever do is say the sky is falling, that things are bad. It doesn't mean we're not making changes, and I'm going to roll forward in that thought process, but I think it's important to understand this is recent history. We don't have to go all the way back to the 1980s to find really crazy, wrong predictions. It's happening right now in front of us. Wall Street was dead wrong. The Federal Reserve, the smartest people in the room, I thought, all they have to do is focus on interest rates. My goodness, how hard can that be? Why we make predictions, I don't understand. It doesn't make sense. We all have our feelings. And why I say this out loud is we say this around here all of the time to remind us my feelings are wrong about what the future is going to be a lot. I don't want to move portfolios on that. We remind ourselves all the time. If you're going to make changes, you'll make them incrementally. If you need money over the next couple of years at all-time highs where we are, this is where you should be pulling money out. Of course. Of course. That's not a sell it all, run for the hills because we're about to crash because Harry Dent says we are. He said that 20 years in a row, 18 years in a row, 11 years in a row. What point is there? I already know what he's going to say. Why don't we just go ditto that page, but paste the same article, flash out some news releases, and off you go. This is what Wall Street does. It's that time of year where we make predictions. It's where people seem to get all wound up. I get more requests for, what do you think about the market? Or I've been reading about all this doom and gloom. Tell me about what this one says. No, It's okay. You can forward them, but I'm not going to be reading them. I don't. And I don't mean to be cavalier about it. There is no point. There's no point in sitting and reading misinformation. Like, I'm going to get something out of that. Well, yeah, but at least you get a opposing viewpoint. No, I'm not getting an opposing viewpoint. I'm just getting somebody who's trying to sell newsletters, who's trying to yell louder than the other people. What we want to try to understand, and I think this is where we get back to it and try to think as we're moving forward into 2024. 2023 was an incredible year. Out of nowhere, we're back to all-time highs. It's not supposed to have happened. We're supposed to have had a recession. We're supposed to have had horrible consequences in Taiwan or wherever else. It was all supposed to blow up. It didn't. And the Federal Reserve kept crushing the bond market more than they said they would. Then they're pulling back. I don't know what they're going to do, but people are really certain what they're going to do. And so they talk every day on CNBC about their certainty of what's coming forward without any humility that they have been so wrong. So wrong, because predicting the future is very hard to do. So let's talk about what portfolios, what we've been doing in 23 as interest rates have gone up, as the market has gone up. If people need income, it's a good time to park more cash, because guess what? Money markets are over 5%. Bonds are up to 6, 7% in some areas. And I don't mean high yield junk either. There are so many opportunities on the income side that we can take, and we're thinking from an income perspective, because that's kind of what we specialize in, right? Is income for life you can't outlive. You've heard me say it a zillion times, right? Cost of living adjusted income, all the days of your life, no matter how long you live. That's what if that's your goal, that is your goal. And so we want to be focused on that, not determining what the market's going to do, but focused on making sure there's not 2 years income, there's 5 years, there's 10 years maybe, when we include income coming in. When we think about the bond market and the stability that we have with it, because we can now earn 5, 6, 7%. It's not that we're shifting to bonds in any radical way. It's as cash is coming in, stock sales have been made at all-time highs. Where are we going to park the money? We're going to park it to the side. Not necessarily permanently at all. But if the market does what it always does and gives us a correction at some point in time, we have the opportunity to move that money back and tie in higher income for the rest of our lives. That's why it's nice to be able to do this. And for a long time, for 15 years almost, we weren't able to do bonds of any kind. We had to look for all kinds of fancy alternatives. And that was great. It was a good call, but it does make it a little more uncomfortable. So as I always say on these calls, I feel more certain that you can take 5% cost of living adjusted income and never run out. That's why, because we're able to build portfolios that actually have a bond piece, higher yielding stocks that can get you that income just by just sitting there. You don't have to sell. And so that's why it seems like a better time, even though I know how you feel, right? Because we all feel that way. All right, let's take a look at the predictions page, Jen, of how often the market hits those Wall Street predictions, okay? So as we look at that, this is a chart I pull up once in a while. You may recognize this, but this is giving us some ranges of returns from really bad markets like -20 and more, all the way up to the great markets of +20 or more, okay? And of course, we just added on 2023. And what is interesting to me is, first of all, let's take a couple takeaways here, okay? Before I go ahead and talk about how silly it is, Wall Street predicting the future. Most of the time, if you're just saying one column, what are you going to bet on? I would say greater than 20%, right? Wouldn't you? I mean, that's obvious. We have more of those things, but that's not what you hear. That's not what you think. That's not what you feel. What you feel is the extreme left. It could be crashing. That's what everybody's telling me. Well, you know what a big bet is? A big bet is that 6% of the time will come true, because over 90% of the time, as you can see on this chart, big drops don't occur. And if I could, let's go to the blue box here and say, this is what Wall Street always predicts. We all know that the market's going to do 10% a year all the days of your life, right? And it just doesn't on a one-year basis. It won't. 12 months from now, 12 months from June, it just won't do it. It's not going to do 10. It's going to do something crazy like up 25 or down 3. But what people focus on are these two areas. Like, this is what JP Morgan thinks. This is what Goldman Sachs thinks. This is what UBS thinks. We're going to do 7%. We're going to do 8. We're going to do 9, because we've carefully analyzed what the market earnings are going to be. Compared that to interest rates, to historic PE ratios. And in order to divine the future, we now think it will do what? Not go up 20%, which is what it does more times than anything else. They never put their neck out. So those predictions to us are pointless, worthless. We don't worry about that, because predicting the future is really not what you have to do. What I will say is this: rarely, I find it very ironic, people focus on these two areas. This is what the market's going to do. Okay, well, it doesn't do it very often, right? About 6% of the time. Or it's going to go way, way down, and that's going to be another exactly 6% of the time. Strange. We fixate on what the market almost never does. It goes down a little or up almost all the time. It doesn't do normal, and it doesn't do extraordinary down very often. That's what we focus on. And I think as humans, we have a hard time understanding that 10% returns for the rest of our life are true, but they're comprised of very big numbers and some losses. That's how we really have to think of the dynamic of the market. So as it plays out this year, our predictions are that the market will be volatile at times. Most of the time it won't. But people will scream and yell like it is, because we're not going to get you to watch CNBC when the market is just like ho-hum. Nobody watches. Nobody cares. They only care when markets get volatile, and then they tune in. So people will talk about the volatility that really isn't there a lot. We feel differently. We don't like what's going on in Washington, D.C., around the world, on our border. Democrats don't want their sitting president anymore. That has nothing to do with Republicans. They always wanted somebody else. Republicans say they don't want Trump. We want something different. But these are the two we have right now. In spite of that, in spite of your feelings that it's not going to get better, it has been. So we try to separate that and not worry about the politics, but I understand that you can't help it, and it's cited so often in the weekly, the daily, the hourly, screaming and yelling from the new Wall Street analyst, the new Wall Street guru, the great guru that nobody's ever heard of, is predicting a market crash. Okay, thank you. But if you had done what Wall Street, not the doomsdayers, just what Wall Street said to do in 2023, it wouldn't have gone well, which is why predicting is a bad idea to move portfolios. So what we're trying to say is what's in front of us. What's in front of us is 5% plus yields in things that aren't even tied to the market. Okay, I can accept that with a percentage of money. So what are we doing? We're trying to tie into some of that. As dividends and capital gains come piling in, where are we reallocating that? We're really not reallocating that to stocks right now, as we're sitting on all-time highs. That's not a prediction the market's going to go down. We're just reallocating to things that are producing yield and will give us an opportunity later to move over. That's all. That's what we want to do. And so as we're looking at and predicting 2024, we're not predicting anything more than energy looks okay. We're getting some return from bonds. So that's okay. We can get some dividend paying things there. What things are cheap? Real estate's still pretty cheap, even though it was the top performing sector. It happens all the time, doesn't it? It's the bottom performing one for the first 3 quarters of the year. Now it's the top in the 4th quarter, playing a little bit of catch up, like things do. We don't have to predict that. We could just simply say the yield is good, and whatever happens in real estate, I don't want to own see-through office buildings in San Francisco. But lumping it all together and saying you can't own real estate, even if it's a logistics company like Prologis, they don't own any see-through office buildings. They don't own any full office buildings. They own full warehouses across the country. They're the biggest REIT. They raise their dividend every year. Their cash flow goes up every year. What that has to do with see-through office buildings and the pending credit crunch that's going to devastate small banks and whatever end of the world discussion we have, I have no idea what that has to do with. It smells like opportunity to me. Throw them all in the same bucket and call it real estate can't own means prices for some of that are probably pretty good. The same thing goes true whether it's shopping malls that are 96% occupied. That doesn't sound like a disaster. Operating with the highest cash flows in the history of the company, doesn't sound like a disaster. But we tend to lump things together. Can't own real estate. And that's when you actually peel back the layers of this nonsense, this drivel that's out there in the internet space. You begin to understand that. Well, what about the budget deficit? What about it? Has that gone away since Ross Perot drew the hockey stick and became an independent party, a third party run for the White House? No, that was the big talk then. No, did government do anything about it? Are you kidding me? Yeah, they did. They raised it. It's now out of sight. When is the end going to come? I don't know. When's the US dollar going to collapse? I don't know. Nobody knows, but they just keep predicting it. And when we sit around and we look at that, we say, yeah, but the US dollar is not what it used to be. Well, what is it? It's the strongest currency in the world. We're the best in a bad neighborhood. However you want to look at it, we are America. We are actually energy independent. You know how big that is in a world of lunatics running wild? It's a huge thing. I know, so politically, they're trying to shut that down. So what? They can't. We're going to keep doing it because we keep using it. And the world is using it. But we've got it. And so we have the strongest currency in the world. Why we keep drawing a line and saying, this is it? I don't know. It's been a sucker's bet. It just doesn't make sense to make those predictions. Let's live with what's in front of us with certainty. And we make adjustments calmly, peacefully, slowly. Nothing big. No all or none calls. And when we are looking at and thinking about how bad our world is, we really do sometimes need to stop and actually count your blessings. I mean it. It's a healthier way for me every day to come in and listen to the noise. And I don't turn on CNBC because even I can't get rid of that noise. Instead, we read, but we read real things, not stupid stuff. We read the Wall Street Journal. We read from real economists that aren't trying to predict the future. Oh, sure, they have little predictions here and there. We think interest rates are going to do this. You can read through and ignore it, but getting the data about what's going on in the jobs market, the real jobs market, not the headline. Okay, so here's a liberal paper that says the jobs number is unbelievably good. JoJo is a hero. Okay, well, maybe that's not quite true. Maybe there's other things that we need to dig deeper in. And that was what I appreciate about the space we get and the people we talk to and we listen to. They're not hyperbolic. We need to relax. And we do. And so as we think about that, well, what's wrong with the world? I get it. It's a lot. There's a lot. I don't think we're on the right track. I agree with the average American. We're not on the right track. We won't even talk about dealing with the budget deficit, but that is not going to kill us today. It'll kill our kids and grandkids. And someday I hope we have that moral discussion of how we're ruining our future generations' lives with our own selfish behavior. But we're not. We're not. We're not. And then you hear the babble. I'm going to give you one more thought, and then we're going to go to some questions. You're going to hear constant babble about this being an election year. And that babble is markets are all up almost all the time in election years. Okay, great. You know, on Tuesdays at 1 o'clock, most of the time the market's up. I don't. These things you just hear about. Like, why does that matter? It doesn't. It totally doesn't. And there's no way to manage portfolios. Almost always the cycles are, no, that's happenstance. There's not enough history. How many elections have we had in modern time, right? I mean, like divided by 4, 20. Oh yeah, our for the 40-year time, we've had 10. 10 is some kind of database I can operate my portfolio on? Of course not. That's ridiculous. It's absolutely ridiculous. So we don't do things like that. And I don't want you to pay attention to that. The reason why is there's always circumstances that are either positive or negative heading into those elections. And we don't know who's going to win and what they're going to do. That's why it's not a good idea to even care that there's an election going on. It'll be louder. It'll be so loud politically this year. It's going to be angry. We have a very divided nation. And for whatever reason, it feels to me like, though, we're trying to find some common ground. I think the extremes, people don't understand. The extreme right and the extreme left are right next to each other. They just don't want anybody else to have any rights. They just want to dictate policy of everything. Your life needs to be lived this way. And they're right next to each other. They hate each other, but they live next to each other. But it feels to me like people are talking more about some kind of, we're hearing Democrats that want to do something about the border. That's interesting. That's different. We're hearing Republicans that want to do things about issues that are important to Democrats. It feels like it maybe is getting better. Let's hope, because it's going to get loud and it's going to feel really tense out there, really like we need to just step aside. I just want you to understand those are the changes that we have been making, not because we're afraid, but because it makes sense. When markets are at all-time highs, it's okay. When we can earn money on your money to leave it outside of the market, and we can't. 5% plus isn't bad with a couple of years worth of income. And the returns are fantastic for pouring in income for those income models. So no, we're not being overly cautious, which of course is why portfolios are doing well, doing better than you would expect in a year like this year. We're very happy about that. That too is a happenstance. It just is. The fact that REITs took off in the fourth quarter, that's great because we own a few. You own a few. It's nice. It doesn't have to happen that way. It doesn't happen in a one-year basis. It's a portfolio. That's why we want to take this time to, I know everybody's talking about it, what's going to happen in the world. And that's why we want to talk about it. Jen, I know there's a couple other things, but let's see. Is there anything, any other slides we wanted to share real quick?
I can go back to it. You just wanted the PE ratio on the valuations on the S&P. Not sure if you want to share that one still.
Let's do it quick, only as a reminder, okay? You've all seen this chart. You've seen it so many times, I know. But I want to remind people of this and how we get caught in this linear world of belief that if we have enough data and numbers, we can predict what's going to happen. So if we can somehow know what the components of the S&P 500, what their earnings are going to do, and then look at history as a guide, you'll see the dead middle there, the 30-year average is 16.5 on the price earnings multiple. Don't get lost, okay? You don't need to have your definition of a PE. This is just something that the price earnings ratio is something that people talk about the market being overvalued or undervalued based on this. That's why it's important, okay? You don't even need to know what it is. But as you'll see, the market is represented by the dark line, almost never trades. Like about, 9 or 10 trading days, over 30 years, 9 or 10 days. Is it where it's supposed to be? So you have to predict what the earnings are going to be. Absolutely impossible. They never get it right. But then on top of that, they will run around and tell you, running that number at 16.5 times that is how we derived our 3,200 on the S&P. Thank you. We're at 4,700. What a great thing that would have been to sit out the market for the past 12 months. Thank you, JP Morgan, for that beautiful insight. Now, what do you think about 2024? Tell me again. This is why we're not saying they're stupid people. You can't predict the future. Let's quit acting like it. And when we do, it becomes a clear thing to say, hey, when we see extremes, where, as you see the top line here going back to like 1999, and we see that stocks are so expensive, maybe you can trim a little bit. But again, it's not an all or none. Or when things are really bad, like in 08, maybe this can give you pause to say, maybe I can own some in a really bad place that we're at. Okay? It's not a predictor. That's why we need to be focused on what are the conditions in front of us, what sectors, what stocks, what companies are cheap, which ones are dear, and it's not this wild chase. It's trimming, it's adding, it's moving slightly. That's what we think you ought to be doing, and that's what we're doing day in and day out. All right, let's grab some questions, Jen.
All right. So far, it looks like we only really have one. When's a good time to take an RMD?
Oh, great. That's a great question. How about now at all-time highs? Okay. Why not? It's not, we don't want to predict where the market is. When it is at all-time highs, go ahead and do that. Okay. But that also reminds me, I forgot to mention this too. 1099 is coming out. As a reminder, folks, you're going to get 2 this year, one from Schwab, one from TD. I know we love TD too. Sorry about that. We did not do the merger. Okay. We wish we could go back to TD. We want them to undo everything. Okay. Can't do it. TD's gone. But we're going to see just this year, you'll see 2. And remember, they almost always revise. Okay. Something. Okay. Not always, not almost always, but for many of you, you find that happens almost every year. Okay. So do not file your taxes when you get your first one. And the second part of that, you'll see in your email a more detailed summary of this. People still forget these are 1099s. This is not your W-2s that are due at the end of January. These are not coming until February. And we ask you to wait on your taxes if you can, so you don't have to file an amendment. Okay. And be careful also, do read that email, because if you're doing any charitable giving out of your IRA, you need to be reporting that to your accountant. As a reminder, Schwab has no idea whether your church is a charitable organization. It's just taxed as a distribution unless you let your accountant know. Okay. All right. Any other questions come in?
Yes, absolutely. Do stock buybacks distort PE ratios? And if so, is there a chart that adjusts for that?
They do. The stock buybacks are helpful. It's just another constant buyer, like Apple buys back stock every quarter, all the time. So they are a constant buyer. Does it distort? Not really, because the PE is really based on how many shares there are outstanding. And don't forget, when companies are buying back, they may shrink the supply a little bit, but a lot of times there's options, or incentive stock that's given out during that period that also dilutes it. In other words, this supply of stock, they're buying back to keep it from booming or growing out. Okay. So it's not all the time that you're seeing huge drops that would distort the earnings per share because there's so many fewer shares. Okay. But that's usually, we're talking a couple percent, and it's good to have that buyer in there. Don't misunderstand. That's a lot of stock that's being bought on the market, helping push the stock higher, but it doesn't really distort it.
And I want to add one thing. I want to apologize to those that weren't able to join at the beginning. We did not realize the capacity was 100 participants. So some people, as they logged off, were able to join partial way through. So this will be recorded like always. It will be on YouTube, and we will email out the link as soon as we're able to everyone. So you won't have missed it. You'll just get to watch the recording instead of live.
Okay. Well, thank you. That's why we're fixed at 100, huh?
Yeah.
Okay. All right. Everybody, thank you so much. And we really, I do hope that we all can count our blessings. We are at the most abundant time that humans have been on Earth, the most abundant time. It doesn't feel like that. We have more access to health services. We have more food. We have the ability to travel. We have information at our fingertips. People are living longer, healthier lives. That's the reality. It's just not what's reported every day. And sometimes we just have to stop and recognize that in a period of growing abundance globally, less people literally in poverty every single day is an amazing thing. And it is a huge driver to the whole economy of the world, which is what the market represents. Yes, there's lots of problems in the world. Not everybody is a perfect person like us and does everything well. And there's lots of dictators and issues. But let's not forget how incredibly blessed we are to have been born in America, the greatest nation on earth, in the most abundant time. Everybody have a great 2024, and don't hesitate to call us if you need anything. Thanks.